I'm Andy Gomes, and I'm a loan officer servicing Lower Fairfield County. Today we're going to talk about the future of mortgage rates. My goal today is to educate you a little bit as to how interest rates move and to provide you my thoughts as to where they're headed. The projections we have today are going to be solely for 2016. As you can see, there's a fortune teller here. We're not a fortune teller. I'm not a fortune teller. What I'm going to do is provide you with a series of fundamental and charting analysis that I've conducted to determine where the likelihood of interest rates will be in the first quarter and on in 2016. We're going to really talk about three different rates today. We're going to talk about the federal funds rates, which just went up recently. They've been flat for the past 10 years, and people are freaking out thinking mortgage rates are going to increase as a result. So we're going to cover that topic. First of all, the federal funds rate is truly the overnight cost of borrowing money from the Federal Reserve. So this is a rate that the Federal Reserve charges banks to borrow money from them. And we're also going to be talking about mortgage rates. We all know mortgage rates, but we're going to talk a little bit more about how they move, why they move, and how to track their movement. And lastly, we're going to talk about the 10-year Treasury rate. This is a rate that the government pays consumers to actually park their money in with the government so they can then lend it back out. This chart here illustrates the difference between the Fed funds rate movement and the Treasury rate movement at the 10-year yield from a period of 2004 all the way through 2006. Now, why did I pick this period? Because this was the last period in recent history that we've seen the federal funds rate actually increase. And to track what kind of impact that's had on the cost of borrowing money or being paid interest on money from the government, I included the 10-year Treasury chart here as well. As you can see, when the federal funds rate was at 1% in June 2004, the 10-year Treasury rate was north of 4.5%. As the federal funds rate started increasing, which logically to our consumers would mean rates would start increasing, the 10-year Treasury yield actually came down. And as they increased and kept increasing, the 10-year Treasury yield really didn't gyrate too much. It went from 4% to 4.5%. So in interest rate movements, that would have the equivalent change in terms of percentage rate. So right now, today, rates are 4%. If this holds true from this Fed rate cycle, we probably will not see rates increase too much. If anything, we'll see rates actually decrease before they start to increase. More recently, what the Fed started doing to kind of curtail the amount of money and liquidity they're pouring into the market, they ended their mortgage-backed purchase program. They were purchasing large quantities of mortgage-backed securities in order to keep rates low and drive rates lower. In March of 2014, they actually stopped doing that. And what happened was, initially, heading into that move, the 10-year Treasury yield spiked up to 3%, where they were currently in the high ones, low twos. And after the Fed stopped buying the mortgage-backed securities in large quantities, we actually saw the 10-year yield drop and mortgage rates drop with it. So this is just another illustration that when the federal government makes the cost of borrowing money more expensive, it does not necessarily mean that mortgage interest rates are heading higher. On this slide, we're taking a look at the 10-year Treasury yield in a 3-year window. This is the most recent 3 years. As you can see, we have been gradually decreasing the rate for the past 3 years in terms of the yield that the government offers to anyone who parks money in their Treasury yields. We reached a low about a year to year and a half ago of 1.7-ish, 70-ish, and we then climbed up in rates, and then we came back down, and then recently, this is right ahead of the Fed increase in the Fed funds rate because the market's always ahead of what they perceive the federal government's going to do. We've climbed back up, and now we've been consolidating again. But more importantly, what this chart shows is the formation of a clearly defined long-term pennant pattern. As you can see, we have recent lows that have been acting as a rising floor in terms of how low yields to go. And we have, if we extend this line all the way from here, and I'm hoping you can see it, we have some recent highs formed a ceiling as to how high yields can go over time. So what typically occurs is we're going to reach a point where the market's going to make a decision as to which way future rates are going. And according to the charting pattern, according to the timelines, this is going to take us into the first quarter of the year. So if this chart pattern holds true, rates should behave up until the first quarter of the year. After the first quarter of the year, once we reach a point that we're going to either break out one direction or the other, we're going to see exactly where rates are truly going to head. I believe they're going to head lower. I believe Treasury Yield will head lower in the long term, but we cannot discount the fact that they could push higher. Now in this chart, we take a look at the movement in mortgage-backed securities for the past couple of years. Now mortgage-backed security trading and the movement has a direct impact on how interest rates trade day in and day out. If the bond price goes up, rates come down. If bond prices come down, rates go up. So there's an inverse relationship. Looking at this chart, the same pattern we saw with the 10-year Treasury yield is holding true. We're reaching a pennant pattern here, and once we get to the end of the pattern, the market is going to decide which direction it wants to go. Higher in price, bringing us lower interest rates, or lower in price, bringing us higher interest rates. Here are some considerations for rates to actually decline in 2016. Number one, the price of oil has been on the decline. Now, why is that important? If the price of oil comes down, that puts downward pressure on inflation expectations. Now, as we know or may not know, if you're receiving a 2% interest on a government bond and inflation is heading higher, that 2% interest is not truly 2% anymore, because over time, inflation will erode the value of your rate of return. So when the market sees that the expectations for inflation are lower, they generally favor lower rates of return because they see that as a rate of return they're going to have over time. So if oil stays stubbornly low at these levels, which I kind of hope they do because it's been great to go to the pump lately, we probably will see inflation levels decrease, and we'll probably be at a little bit of a risk of deflation, which is actually very bond friendly, and it helps rates stay really low. The price of metals have been on the decline. The price of gold has been dropping. The price of iron ore has been dropping. Copper, everything has been dropping. This further supports the theory that inflation down the road will remain pretty low. U.S. manufacturing has been slowing down. Factory orders that have been released have been much lower than they have been in previous years. This kind of foreshadows a little bit of a U.S. slowdown coming down the road in terms of manufacturing. And let's think about it. When the U.S. economy is doing really well, factories tend to up their orders. They tend to make more of what they make, and when they see that those goods and services are not being used by the consumer, they have too much in terms of built up stockpile of whatever they make. So when they slow down, that means that the consumer demand for what they're creating is slowing down. So that's foreshadowing the fact that the economy may be slowing down in the coming months. Global economies have been slowing down. Eurozone has not been doing too well. Other parts of the world have not been doing too well. China is kind of crashing in terms of what their stock market has done this previous year. Their economy has definitely been slowing down, and they're one of the largest drivers of global economy is China. So if they slow down, that means most of the world's what produces goods for people in China to buy, the demand for that's going to come down. So that further supports our manufacturing declining levels in this country. And if that actually transcends into 2016, that's not going to be a good case for rates to head higher. Rates are very low in the Eurozone. The difference between what our U.S. government is offering for people to park their money and receive interest on and what the Eurozone is offering is huge. The 10-year German Bund is what I normally use as a metric. Currently, they're paying about 0.60%. So if you're not happy with the rate of return you're receiving by parking your money in money markets here, try going to Europe. You're actually paying the bank to hold money for you over there in some cases. So as long as rates stay low in the Eurozone, we're probably going to see a lot more foreign participation in our own markets in terms of buying our own debt in mortgage-backed securities and in Treasury yields. Because if you're in a foreign country and you believe that your currency level is dropping because our government is making our dollar stronger by increasing the Fed funds rate, you're going to make money two ways. One is you have a higher yield parking your money in our country, and two, you may have a favorable currency level because you're buying dollars currently which are not as strong. And if the dollar strengthens over time, because you believe it's going to strengthen over time, when you convert that money back into your currency, you're making money twice on the yield you're receiving and then again on the currency swap. So that has been in vogue this year, and it has been helping to keep rates low. I do believe that's going to continue heading into 2016. Here are some considerations for interest rates increasing in 2016. Now, I'm on the other side of the fence, but I have to play devil's advocate. U.S. is near full employment. The employment numbers we've been receiving have been much, much better. And as the U.S. enters into a further recovery from the economic recession and employment numbers continue to improve, if we start seeing a little bit of wage-based inflation, meaning normal people are getting paid more for the same amount of work, that's going to put a lot more dollars to work into our own economy, and that normally drives up the cost of goods and services. So this is the case for future inflation. And if this was to happen, and again, if you're an investor trying to park your money and earning a yield, if say you're receiving 2% and tomorrow you believe inflation is going to erode the value of your rate of return, you're going to want to demand a higher level of interest today in order to protect yourself from that. So that's a case right there for interest rates moving higher. The Feds may no longer support the market. The Feds have been buying large quantities of mortgage-backed securities up until about a year ago. But what they've been doing is continually reinvesting the principal interest they've been receiving on these large quantity of mortgage-backed securities and treasuries they purchased over the years. If they stop supporting the market by reinvesting what they're earning from these acquisitions, that's going to cause rates to head higher. I personally don't believe they're going to do that. They're probably going to exhaust the Fed rate hike cycle before they start doing that, so we're probably years away, but you cannot discount the fact that it may happen. And lastly, increasing wages combined with decreasing commodity prices could spur a greater level of consumer confidence. And when consumers are very confident, they tend to spend money. They go and they buy a nicer car, they buy a larger home, they go on vacations, they have a lot more discretionary income, and this is all the items and things that support stock market rallies. The stock market has been rallying up until this year. 2015 was pretty soft for the stock market. If we see a continuation of the recent rally and we don't have the Fed supporting the market anymore, we could probably see traders demand a higher level of interest on treasuries and mortgage-backed securities in order to kind of close the gap between what the stock market will return and what bond traders are offering. So that further supports the case that we may see interest rates increase. Now, I think that this version of considerations for rates to increase don't hold as much weight as the considerations for rates to decrease heading into 2016. In conclusion, I found the chart that shows the 10-year yield from 1790 all the way through 2010 and beyond. What you'll see here, and it's pretty interesting and cool if you think about it, on an inflation-adjusted basis, you would receive a higher yield from the government in the 1700s than you would receive today, which is kind of shocking if you really think about it. And throughout history, there's only been a couple of points where we saw large movements in Treasury yields. One was heading into the Roaring '20s and the aftermath of the Great Depression, where yields dropped considerably. We then, after the expansion that was created by the post-World War II era, we saw rates just climb higher and higher to a point where they just were not sustainable, into the teens. From that point, we've seen one of the greatest bull markets for bonds we've ever seen in history. And this chart will show you it. This is the most recent bull market. This was from the 1800s. This one is huge. Rates, if you own the bond from the 80s or the 70s, you've done pretty well. You've done extremely well if you own one of those bonds. And we're heading to a point now where we've challenged this level again, this post-World War II level in terms of low end yields. And think about it, this is after a war. The economy was not doing too well. As soon as the economy started doing well, rates head higher. And that's a big indication as to where rates are heading. We've seen rates come to slow because of the Great Recession we just came out of. And we're not 100% out of it yet because now the global markets are in a recession. As soon as we do leave this recession, the next course for interest rates, at least the next trajectory, will be higher. Now, I don't think that's going to happen in 2016. I think there's a greater chance of that happening in 2017 and beyond. But if you're considering purchasing a home or considering moving up to a larger home at some point, 2016 may be your last year to capture a favorable mortgage rate that will hold you for the next 30 years or however long you stay in that property. So in conclusion, rates are phenomenal. History proves it, and it's something that should be taken advantage of, or at least a conversation should be had about it. So if you want to know a little bit more about how interest rates move or have a conversation with me, just give me a call at any time.